Bond rates is not my go-to dinner party discussion topic, but here goes. The world's most powerful central bank has changed the way it considers inflation, and that has implications for interest rates. You'll see here that US inflation usually undershoots the central bank's 2% target. It now says it's happy to let inflation average 2%, which suggests it'll tolerate inflation above the target for a time. So interest rates can stay lower for longer to rev up the economy and inflation. It also means those investing for a longer term want a higher interest rate because future inflation is expected to be stronger. That's a problem for the Reserve Bank. Take the Aussie 3-year bond, which is the benchmark for a range of lending products offered by banks. The RBA doesn't want this rate to go beyond its target, so it's going to have to intervene in the market to drive that rate lower. The Fed's new stance lifted most equity markets, but the Nikkei dived on reports that Prime Minister Shinzo Abe was set to resign. But domestic shares were held back by a sell-off in mining and energy stocks. COVID has been kind to the electronics retailers like Harvey Norman, which reported a 20% lift in profits. But it's devastated cinema and theme park operator Village Roadshow, which slumped to a $117 million loss. The tech sector has been the major driver of US equities, and that's partly why the Australian market has been left behind this year, our relatively small tech sector. Interest rate expectations undermined the US dollar, so the Aussie dollar is approaching 73 US cents for the first time in nearly 20 months. And that's finance.